In this lecture, we will discuss consolidation in the presence of a non-controlling interest. First of all, let's refresh ourselves. What is a non-controlling interest? So a non-controlling interest occurs when a company owns a majority but not all of a subsidiary. So you can see on the far left, we don't have any non-controlling interest in this because no one owns a majority of this subsidiary. It's a joint relationship between three parties in which no one has the majority ownership. And on the far right, we see a situation where Company A has the entire ownership of the entire entity. So there's no non-controlling interest there because there's no other party involved. But in the middle, we see that Company A owns a majority of the subsidiary, but someone else owns a big chunk. So that's where a non-controlling interest is present. It's basically when you own between 50 and 99% of another entity. That's when we have a non-controlling interest. So to sum up how this affects the consolidation process, let's think this through. When control is achieved over an investee entity, consolidation is required. But when control exists but isn't complete, like in the previous slide where we own most but not all of a subsidiary, a non-controlling interest is present representing the interests of that other owner. The presence of a non-controlling interest changes the consolidation process. So when we do the consolidation process, we still prepare consolidated financial statements, and the consolidated financial statements are still presented as if we own 100% of the subsidiary. So when we take revenues from the parent and we add them to revenues from the subsidiary, we don't take 80% of the revenues or 70%. We record all 100% of the subsidiary's revenues on our consolidated financial statements, even though we don't own 100% of the business when we have a non-controlling interest present. To account for this, a non-controlling interest account will be reported on the financial statements that says, hey, we've presented revenues, expenses, etc. as if we own 100% of the subsidiary, but actually we don't. So the share that is not attributable to us of share of net income or share of net equity or whatever is presented on a line at the bottom of the financial statements. So on the next slide, we see an example of an income statement with a non-controlling interest present. This is 3M's financial statements for 2022. And if you look at about 2/3 of the way down where I'm running my mouse along here, it says we have less net income or loss attributable to the non-controlling interest. And you can see the amounts for the 3 years there. So if you look at this net sales number up here, for example, this is 3M's parent company revenue plus the subsidiaries, all of the subsidiaries revenue, the whole 100%. And this number includes all 100% of the subsidiary's cost of sale. And this net income or loss down here of 5,791 is net income that includes that non-controlling interest. But then right here, they've pulled out the net income that's attributable to the non-controlling interest on their income statement. And they do the same thing on their balance sheet. So this is the equity section of 3M's balance sheet for that same year. And you see that they've got a regular equity section with common stock and APIC and retained earnings, treasury stock, and so on. But at the bottom, they've got an additional section titled non-controlling interest, and that shows the share of total equity that is attributable to that non-controlling interest in a 3M subsidiary. When we're doing the journal entries to actually do the consolidation process, here's what looks different. So with entry E, which is that first entry where we eliminate subsidiary equity, the debits are all the same. We're clearing off retained earnings, debiting common stock, debiting APIC. We credit investment just like we've done in the past, but we only credit investment for our ownership percentage. And then that remaining amount of equity that's not really ours is going to be recorded as the non-controlling interest. And this is the amount that gets reported on the consolidated financial statements as a non-controlling interest. We do the same thing with entry A, which is the entry that we use to allocate the accounting acquisition premium, those amounts paid above and beyond book value of equity. The debits are the same. We debit our recorded and unrecorded assets and we debit goodwill. But again, the credits are allocated between the investment account and non-controlling interest. Now, there is a little bit of a difference when we allocate goodwill to non-controlling interests. We'll get to that in just a bit. After acquisition, we've got similar changes. So when we apply the equity method, we apply the equity method at our percentage ownership instead of at 100%. And changes in the investment account with the equity method will be recorded as a change to non-controlling interest. Entry C, when we do consolidation, will undo whatever we did with the equity method, just like always, no change there. Entry A and E will be prepared like we talked about on the previous slide with a proportionate credit of assets and liabilities and equity accounts between the investment account and the non-controlling interest based on ownership percentages. Entry D actually stays the same because when we're allocating or recording excess depreciation and amortization, that shows up at the top of the financial statements, which is presented at 100%, not with the non-controlling interest taken out. So we actually don't do any changes to entry D in the presence of a non-controlling interest. We still record 100% of that amortization or the depreciation on the consolidated financial statements. And then entry I is still used to eliminate intercompany transactions, but I will tell you that gets really, really messy. So that's kind of outside the scope of this course. All you really need to know for the purposes of this course and for the CPA exam is that gets really complicated. And if you have the privilege of doing that in your job, then you will become an expert in it. Let's talk a little bit about goodwill measurement in the presence of a non-controlling interest, because that's kind of the only part that works a little bit differently, that's not just dividing based on proportional ownership. Remember that goodwill is the difference between the purchase price of an acquisition and the fair value of the net identifiable assets. And it can represent some intangible things, some unquantifiable benefit like excellent employees or strategy. It's just this excess amount that you're paying above and beyond the fair value of the assets you can identify. So it's kind of a nebulous concept. Sometimes it's legitimate. Sometimes, though, it's just there because the purchase price was higher, because you had to pay more to get enough shares to get that controlling interest. That's called a control premium. So if you're paying excess for an acquisition, not necessarily because the acquisition has any identifiable asset that's really valuable, but just because the sellers won't sell unless you pay more to get control, that's a control premium. And the control premium, because it doesn't really represent the value of the subsidiary as equity, it's all got to be allocated to the acquiring company, the investment account, not to the non-controlling interest, because the non-controlling interest didn't pay the control premium because they don't have control. So that means that we're going to allocate a little bit more goodwill to the parent than its ownership percentage may indicate. So here's an example. Blue Co. purchases 20,000 shares, 80%, of Green Co.'s outstanding stock for $16 a share when the prevailing market price was $15 a share. This indicates that they're paying a control premium. They've paid $1 extra to be able to get the deal done and get control. Green Co., their identifiable net assets had a fair value of $350, and we need to figure out how much goodwill will be apportioned to Blue Co., the parent, and then how much goodwill will be apportioned to the 20% non-controlling interest in Green Co. So the fair value of Blue Co's shares would be $20,000 times $16. That's what they paid. They paid $320,000 for those shares. And if we take their proportionate share of the net assets, which were valued at $350,000, that share is $280,000. So comparing that numbers, the stock price that Blue Co. paid for Green Co. compared to the book value of their share of the book value of net assets, is that difference is $40,000, and that's the amount of goodwill attributable to Blue Co. Now for the non-controlling interest, the fair value would be $75,000, the remaining 5,000 shares of stock, and we're going to value those at $15 per share because they didn't pay that extra dollar to get control. So their fair value of theirs is only $75,000. Then we figure out their share of the fair value of net assets by taking $350,000 times 0.2. And we see that the goodwill that's attributed to the Blue Co. subsidiary or the Blue Co. non-controlling interest is $5,000. if we add those two numbers together, we get consolidated goodwill of $45,000.